Okay, so I can't get into the details of every line item here, but I do want to, and I'm happy to, just post in the Facebook group. I'll post it up there for you. This does not mean this is your org chart. This is like my why is not your why. But I do think functionally you're going to find similarities, particularly amongst e-commerce companies. So we start everything from business development side. Where are the ideas coming from? Where are the brands? What kind of partnerships should be out there? Are there particular sales channels that we need to work on and kind of, this is like really the ideation piece of the puzzle, right? If we're going to go to social media influencers and build a network of influencers and partners, a lot of these ideas get tested in biz dev. That's a lot of mistakes, a lot of headaches come out of biz dev because they're like, hey, let's try this idea. And I say, okay, cool. And sometimes this involves a number of people, sometimes it's just me, but there's a lot of fail fast action happening. Merchandising. This is how we make products. So this is product development, some people call this. It just depends on your nomenclature. Boy, those birds are loud. So this is where you manage your brands, right? If you have more than one brand and they're of sufficient size, you maybe need more than one brand manager. Again, as you develop products, you're thinking of new products, how you do your research, blah, blah, blah. Existing products you need to maintain and optimize. They should be hitting margins. They should be managed actively. If they're not, well, you're going to get variable results and surprises. Then, of course, you have marketing, all kinds of different marketing and advertising functions managed within there. Sales, if it's related to a company like Jason's or companies like mine, we'll often be multi-channel, and so we'll have different kinds of sales structures that you need to manage and maintain. Operations, of course, this goes everything from the physical sourcing elements all the way through the complex logistics and shipping and so forth. But it can include your own warehouses and safety and just managing of external resources like 3PLs. And business intelligence, so this is your analytics, however you want to think of it. And you have to do analytics for all of these different departments essentially. And there's different kinds of analytics. We look at the types of things that Adam and Rob have talked about, getting really deep into tracking and PPC and effectiveness and behaviors. And then we look at margins, how are we doing on margins, and are there opportunities to increase margin? That could be doing split testing on prices, that could be beating down suppliers, that could be optimizing your supply chain. There's lots of ways to do these things. Time and motion. I remember when we implemented NetSuite, and I'm sure somebody will be able to repeat this story later with me in Parsimony, where we watched somebody fulfill a sample order and they had to click like 27 different clicks when we first implemented NetSuite. And we're like, why are you clicking so many things? And the reality is there was probably 3 clicks that he could have done, but he's like, well, that's just the way I learned it. And so it's like, all right, so every now and then you need a time and motion study. Are you guys familiar with that concept? Where you just kind of watch how they do it, and then you decide if that's, sometimes they have a better way, and sometimes they're missing a step, and in many cases you're like, wow, that's the worst process ever. We need to fix that. So those are ways of adding business intelligence or BI. And then IT, to whatever extent that's relevant to your company, if you have phone systems, if you have your own servers or any of that kind of stuff. Even the management of passwords is a complex thing, right? So, and then finally, you got to keep track of the numbers, the bean counters at the end of the deal. So if you kind of follow this flow, you have ideation, right, kind of on the left, all the way through down to where you're measuring and managing on the right. That's kind of how we think about stuff. It doesn't make it right for you, but it's a conceptual thing. All right, so I'm going to chuck in a little bonus here. Achilles and Constantine have said, hey, we want to deliver overwhelming value. That's we get the message. We've already shown you a little keyword density thing, and we'll touch on that again. But we want to throw in some more stuff. Is that okay? I said, it's okay. So they've said, hey, here's some of the stuff we do. We're going to give it to you guys at a lower price. So they have product listing, optimization, copywriting stuff. They give you a price break, and we'll post this in the Facebook group. They've got product photography that they will do for you. This is really down that tactical level stuff that you need, but maybe you don't always have a simple answer for. They got a price break for you there. One of their other properties, Viva Rate, they can help you with product launches. they have both US and EU, right? So I talk to many people, they're like, I don't know how to do a launch in here or there, whatever. So these are opportunities for you guys to work with their system at a better price. They've got the listing and optimization for all stores. This includes the translation, yes? Yeah. So they do some of these things that we've talked about, and it may be a faster way for you to get through the checkout lane. And then finally, they've got PPC management set up, the whole thing. So this will be in there for you. I think there's one more screen. This is a bundle price. So this includes the whole enchilada, and they'll manage it by kind of a fixed fee per month. So there's setup fee, right? That's where all the pain and suffering is. And then there's an ongoing fee. This is a normal agency kind of concept. So I encourage you guys to look at it, scrutinize it, and see whether there's a fit for you. And then, again, to follow up on the keyword density tool they talked about yesterday, email contact@amzstellar.com, and then they'll get you the forever free credits. So they've gone to a big amount of work, so let's give it up to the guys. Thanks, guys. Lots of good stuff there, so thank you. Okay, so I'm going to go pretty quick. And I like to start out with all of the things I tell you are things I truly believe, and I have self-assurance, so I can probably make you believe them too. I may or may not be right. Dark side of self-assurance is even if I'm wrong, but I think I'm right, I'm going ahead. And and as I've said to people, sometimes when I tell you things about the future of how you sell a company or whatever, they're like, well, but I don't like that. It's like, I don't know. I don't know what to tell you. That's the way it is. So just understand, these are my opinions, and it's a result of experience. And people ask me all the time, well, what are you doing? It's like, just go to my website, StephenSimonson.com. You can find out what I'm doing. Everybody also says, I don't want to deal with any of the pain of this. Just skip to the end and tell me what's up. And, just tell me how much it's worth. So my answer is it depends, right? They're like, well, how do I get more? And it's like, well, you got to know the components that it depends on and maximize those components. And then how am I going to find a buyer? And what is that going to look like? What's that deal transaction going to look like? So we're going to talk about some of these things here. Here's different deal types. I'm not going to go into every one because they're not relevant to you. But some people say, gosh, I want to grow my company really fast, so I'd like to get some outside capital. How would I do that? That's growth capital. You go out, venture capitalists in the right conditions will say, here's some money, and they take a minority share, and they're like, all that money goes in the company, and let's go, get big together. You retain majority control, and off and running. That exists. Do you guys know how those deals work? You understand that principle? So they're minority, you're majority. They do have certain negative controls, so you aren't buying new yachts with the money. So that's a common growth capital round. A recap, as you get a little bigger, you may still sell a minority share, but you want to take some money off the table and make what I call the wham, a little walking around money. And when you have some wham coming off the table, that's a recapitalization. So some of the money, the majority typically goes into the company and some goes into your pocket, but they're perfectly fine to support that for the right conditions because they want you to have a sense of security, right? That you're not doubling down again, that you have just a little something to kind of keep you happy. And then there's other things here as well. But most of the time you guys are looking at, you want to just sell the whole company, right? So that's the total asset sale, called typically an asset purchase agreement, or a corporate buyout. That's kind of like where you're buying their stock or they're buying your stock, whichever the case may be. The types of deals on the right, the guys who run these deals are either, I know a guy, he wants to sell, I'm going to buy it, that's a direct deal. Smaller deals are where business, Main Street brokers I call them, they come in, deals less than $1 million of EBITDA. So if you guys, who knows what EBITDA is? Raise your hand. Well, those are some lackluster hands. Whew. Next time I'll say, lower your fingers. Yeah. So it looked like I got some sort of flinching and twitching out of you people. So I'm going to say you know what those are, or EBITDA is. So anything $1 million or less in EBITDA, that's probably going to be a business broker because the deals just aren't big enough for an investment banker to care. But the best deal valuations are typically going to come in from an investment banking standpoint that are specialists, they're niche players, and they have a direct focus. I know that's not huge, but everybody in the Amazon space has been trained to think that companies are worth 2 to 5 times earnings, right? That's, what are my buddies called? Website closers. And not my buddies, just to be clear. I don't like how they operate. I think they're predatory when it comes to inexperienced entrepreneurs. So they've trained the market of buyers, they've trained the market of sellers, hey, plan on 3 times. About 3 times earnings. Maybe, and there's exceptions, maybe you get 4, maybe if it's not as good you get 2. But here's kind of deal enterprise values. Now this starts at 10 million. So 10 million of enterprise value, the average was 5.9 times earnings. Now, if you are making only $1 million EBITDA, you're probably not worth 6 times earnings. That said, there could be exceptions. One of our friends had about $1 million EBITDA and he sold for 110 million. So that's not on this chart. The point is, your own company and its merits based on some of the formulaic pieces I'm going to give you are what drive the valuations. So just know that, you know, as you get a higher enterprise value, and this is, so it's your EBITDA times whatever the multiple, that's where these deals start coming in at higher valuations. Okay, so what does the equation look like? The value, or the multiple, is the long-term past profit. Okay, so the longer the term, the more value it has. If you've only been in business a year, but it's profit, fine. 2 years is better, 3 years is better. Not that it aggregates, but it just shows a trend, it shows a history. And the faster that past profit is growing, also the growth rate on top line sales, right? So if you grow your profit by 50%, but your top line doesn't grow, they're like, cool, you're efficient, but you've hit the end of the road. Anybody who buys a company wants to grow the company. They don't want to buy it and keep it the same. The only way they make money is if they can, you know, triple, quadruple, really, you know, most guys want a 10x it. And then they want to sell it again probably. So your growth rate on profit and sales. Do you have systems? Michael already talked about it. If you have an ERP system, and I don't care which one you have, you're probably going to get one more potential multiple out of it. So you were worth 4, now you're worth 5. So you start thinking about, oh, now that's why guys pay hundreds of thousands of dollars for NetSuite and Oracle and all that. Because not only does it make your business run efficiently, but it gives you tangible value on the outside when you're exiting. Now you're into the people. What kind of management team do you have? If it's all you, your value is right here. If you have a management team across those verticals I just showed you, especially the less relevant you are, the more the company is worth. Intangibles, these can include the business risks of, so this is divided by now. So all of those things, it's like this times this plus this, this, and this. But now here's the things that start taking away. What's the business risk? I've only been around a year, so the timeline, that's a business risk. I'm only in one market, that's a business risk. Amazon suspends my account, you're done, right? You know, at least you're off, and that's pretty risky for a buyer. It could be the size of the market. I sell, you know, buggy whips, not a huge market at this point, right? So all of those types of things can be a factor. And then there's unknowns like if you sell beauty products and you've been running around selling them illegally, you know, compliance-wise, you're saying pure or whatever, and it's not pure, that's an unknown business risk. And obviously buyers will be looking for that during the due diligence process. The types of things that drive valuations are free cash flow down on the left side, assets. We talked about assets that you may not think about, right? We all know if we own buildings and factories and equipment, those are clear, tangible assets. But your customer list, that's an asset. You know, many of you guys have tens of thousands, maybe hundreds of thousands of customers. Just having them on a list, by the way, that's okay. Having some kind of list that you're hitting at least weekly, an engaged list, that's worth much, much more. Especially when you talk about the branding stuff that Chris and Nicole were talking about. Excuse me. And then, of course, there's other factors that may be relevant. Pardon me. All right, get ready for the pain. So the entire process sucks. You'll hate it. You'll rue the day you began it. And you'll probably blame me in some indirect way for it. So that's why I said I'm not responsible. The way you can minimize the pain is having your ducks in a row ahead of time. The more you think So even if you say to yourself right now, I'm never going to sell my company. I have no interest in selling my company. But you prepare it so that you run it so that you're preparing to sell it. You're going to have a better organization. Your people are going to be better prepared. The systems will be better organized. Just pretend like you're going to take it public. And just, you know, you don't have to start getting compliant with audits on day one, but just imagine that kind of evolution. And what would you do if that was the case? What would you do if you had to answer the board of directors and the auditors and so on? I'm not saying that you have to get fully down into the weeds of compliance, but think about it from a systemic, long-term basis. It will minimize the pain because due diligence will be a snap for somebody who has their ducks in a row. It's like, oh yeah, you need the, you know, literally a diligence stack can be, you know, an inch plus thick. And they want to know, you know, every possible thing they could, that would avoid and make the deal bad. And by the way, when we buy companies, we ask for the same inch stuff thick, right? Any buyer is just terrified that they're going to get screwed. And any seller just wants to get the deal done. Tax planning, this is a big deal. There's lots of different countries here. There's lots of different variables. All I can tell you is you don't start planning the tax when you make the sale. You plan the tax 2 years before you make the sale, or at least a year before you make the sale. Think about your employees. You know, I like to say, you dance with who brung you, right? So make sure that there's some little, piece of the puzzle that helps retain them and helps reward them. Think about a successful transition. Your business, which shouldn't be an emotional thing, but there's probably a little pride there. It'd be nice if things went well and you could go, hey, yeah, that was my thing and now it's their thing, but it's cool. That's a nice feeling. And then obviously your documentation is the final thing. Tail liabilities are things like if you sell a company, you sell a corporation, you've already made in the contract a bunch of, they call them reps and warranties. So representations of warranties. This is you personally guaranteeing that no, I don't have any toxic waste hidden in my servers, or whatever it is. It's a bunch of those types of things. And those tail liabilities can sneak back up on you because if they bought the stock of your company and somebody files a lawsuit against that company within a year and they assert that you did something wrong, you can still be on the hook for some of those types of things. Not on a personal level through the company, but the company who bought you may have some hooks into you for that deal. So you want to make sure you have a really good lawyer who understands how to minimize and manage tail liabilities. Everybody understand that concept? I know I'm going fast, but we all think when we sell about the money first. And I'm telling you that you better think about that last. All the rest of this comes first. And I'm not trying to scare you. I think it's a very, very good business and one of the most unique elements of what you guys are doing. To be able to have a product and sell this business and then flip it and do it again. You have a non-competition on this little sector, but the rest is okay. Extraordinarily unique. And it can be extraordinarily lucrative. Think of it like building a house. Here's one, I built it, now I sold it. Oh, now I got a little pot of gold, I'm going to make a bigger one. Now pretty soon you're making downtown high rises. It's a very, very interesting thing. But the same thing goes for SaaS companies or anything else. It's really all the same thing. You guys can read this in the spreadsheet, but all the things I've talked about, the point is make them better, right? And just like Michael Shinnick talked about, just drive each one a little bit better, a little bit tighter. The faster you grow, the better you have your systems in place. Are you building an actual brand that has value? Those types of things are critical. So does anybody have any questions?
Yeah, on point 9 there.
Yeah.
Does your business have an operating system? What do you mean by that?
That would be like an ERP type system.
I see, right.
Yeah. So it doesn't have to be ERP. There's some companies that a CRM would be enough for. There's other companies that a PIM would be enough for, right? But if your company is going to do operations, it's going to do sales, it's going to do marketing, ERP means enterprise resource planning. That's most elements of a system. There's manufacturing companies that have something different, MRRs.
What I would like to ask is, there's many things we can outsource in business, and I'd be interested to ask you if there's any services or agencies or anything that helps to put these things in place or strategically work towards them if you don't already have it done.
So there are different types of companies. So there's one of the things that we're trying to do, again, kind of on the group basis, is try to negotiate better deals. So through Empower, we have a deal with a boutique banker. and they have a really lucrative money-saving deal for the members, right? So the average broker might charge you 10% to sell a qualified deal, they'll start you at about 5%, it goes down from there. So already it's a ton of money. That type of person will help you build a book that will show you, your business. They won't do any kind of coaching up until that point. There's another Main Street broker type of guy that we know, and they'll basically work with you over the course of a couple years to tell you to get your stuff in order. They're more a traditional price point, right? Because they're also smaller deals, so it's going to be probably that 10% range. We don't have a deal done with them yet, but they can help you when you look at them and you talk to them, and they go, this is not good enough, not good enough, not good enough.
Yeah.
So that's one way to do that.
Very good.
Yeah. Any other questions? Anybody terrified about selling now?
Just a remark, you noted earnout for a sale.
Yeah.
I've had an earnout for a sale.
Mm-hmm.
Make it as short as possible.
Good point.
What we did is sold 40% of the company, and then we had an earnout for 60%. Always do it the other way around.
Done.
The first part make it worth your while, and the rest is just a bonus. I spoke with a lot of. Sorry.
What is the
Earnout is you set certain targets for the valuation of your company, and if you hit that target, that's the amount of money you get for the second part of the sale. So, and we actually had a sliding multiple. So if we hit the earnout, the target, it was certain valuation, and if we exceeded it, it was a higher multiple. If we went below, it was a lower multiple. The thing is, last part in your earnout, you're not the only one making decisions. So it's the whole environment and an influence on decisions you make. So it's getting harder to do the earnout, and you get struggles.
So this is the fundamental point. I'm glad you mentioned that. So in an earnout scenario, first of all, almost all of you guys should just say no to an earnout. On a product basis, you're going to be totally out of control, and so there's no point in it. They're trying to hold you accountable for your forecast and for all your promises. That's why they want the earnout. They're like, if this is so awesome and it's going to grow so great in the future, then go ahead, you ride along with us, right? You probably will have at least, if you're doing this, all right, the U.S. piece of the puzzle makes a challenge. So in the U.S., most companies are financed by the SBA for small level deals. Let's say $1 to $4 or $5 million valuations. The SBA will require the buyer to put down 10% and the seller to do a 10% over a note. Doesn't have to be an earnout. It could just be a promissory note. So you're going to get roughly 80%, it's between 80 and 90% at closing. Those are for smaller deals, and I would highly negotiate no earnout as much as you can. The only time I would do an earnout is if your happy number has already been met, as you're just kind of alluded to. If you say, well, gosh, this thing is worth $2 million to me, and you can get $3 million on the total deal, and the earnout, puts you at 1.8 in cash, and then you still have another $1 million upside. Maybe that's worth it, but just highly negotiate that. And remember, you're in charge of anything you decide. What you say yes to is up to you. What you say no to is up to you. Don't let attorneys or brokers or anybody else push you past your comfort zone.
And also use an attorney for the deal that is very, very experienced with deals like this.
Right.
We used an attorney that was very good, and we agreed upon certain terms that were not very preferable for us. And he was like, oh, no, you're not going to accept that. And then he actually came in and he changed the deal for liability, changed it instead of 5 years back to 1.5 years.
Yeah.
And we were still in earnout, so actually there was no risk. So
Yeah.
it's very good to have a good attorney.
It's essential, honestly. So you're going to have a, kind of a financial advisor. You're going to have a legal advisor during this process. So that's the non-brokers. This is not your brokers, right? This is how you're going to do your taxes, how are you going to realize this income, and then how are you going to structure the deals. So it is a complex thing, but it's extraordinary to be able to take something and build it and create wealth and equity out of it. That's the point of what you guys are doing with a financial instrument like a business. The only other thing I'll tell you, and then we'll take a quick break here, is a lot of you guys are like, I know what I want. I want 100% in cash, unmarked bills at closing, and I'm out of here, right? And don't call me, right? And so I will just tell you that although those deals may exist on some level, they're harder and harder to get, and you're definitely not going to get the maximum valuation. This may be ironic, but the best valuations, especially if you're in the million EBITDA plus, is to sell the majority share of your company, let's call it 66%. You hold back 33%. And I know mentally everybody's like, I don't want 33%, I want my money, right? But in many cases, you can get a better valuation or an equivalent valuation in cash at closing if you will accept this majority-minority concept, and I'll talk you through it. So let's say the $2 million was your happy number, and you got, you know, if you walk away with cash and you still own 33%, you should be even happier. And I know a guy here in the UK, he did this exact kind of deal. He sold his 2/3, and he got the cash he expected to get, and his valuation was higher, but it's like, you know, if it goes, it goes, I don't care, I got what I wanted. So he was happy. And 3 or 4 years later, they sold the company because they did what they wanted, and his third was worth 3 times more than his first bit. About 100 million pounds on the backside, by the way. So my point is, VCs or private equity guys, these types of guys want somebody who says, I'm willing to go with you. Your knowledge isn't gone in a vacuum, disappeared with the, you know, as your car drives away. If you can stay in, you don't have to be active necessarily day to day. It can be a short-term time zone. You can have very precise requirements. But if you'll do that kind of deal, you'll get a better valuation.
Yeah, I'd like to ask you, in deals like that, how likely are you to be able to put in a clause like, after so many years, I want to buy back the equity I've sold to you, something like that. So you could kind of use it as like a way to get cash into the business, and then later on.
Yeah, 0%.
0%.
Yeah. If there's a -% that would be it. So I told you about the upfund guys who I like. Their equity offer is, hey, buy some stock in our company, but if in a couple years, if we're just going to call it a loan and we'll pay you 8%, it's like, I'm not a banker. You know, if you want an investor, you get an investor. You want a banker, go to a bank. And so that any sophisticated guy, I'm not saying you couldn't talk somebody into it, but any sophisticated deal would never touch that. It's a great idea, unlikely to work. There are lots of other things. There's venture debt, there's commercial banks, there's many, many ways to get money. I just want you guys to focus on, get your ducks in a row, think about that big future, you're creating equity, and then don't forget some of the things we've talked about. So I think that's it. Any last questions? Then we're going to take a break till 3.